Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Ying Wang, head of North Asia Industrials, Property, Consumer, and Utilities at Fitch Ratings. In today's podcast, I'm joined by my colleague Katie Chen, Senior Director of Fitch Ratings, and Franco Lam, Director, to discuss the latest development in China's AMC sector. Katie and Franco are part of Fitch's APAC non-bank financial institutions team. Katie is based in Taipei and Franco is based in Hong Kong. Katie, it's great to have you back with us on China Perspectives. And Franco, welcome and thanks for joining the podcast.
Thanks for having us in.
Thank you, Ying.
Okay, Franco, let me start with you. You recently published a market commentary titled Reforms Put China AMCs on Path to More Sustainable Business Model. Could you please give us a quick recap of the recent regulatory reforms impacting Chinese AMCs, and how do these updates impact the sector's long-term sustainability and profitability?
Right. Thank you, Ying, for the question. Right. The recent regulatory reforms and guidance have expanded the business scope of asset management companies in China, which allow them to acquire a broader range of distressed assets, including special mention loans and certain assets from non bank financial institutions and corporates. We expect ongoing government support policy to promote the sustainable development of the sector, as these opportunities would allow AMCs to play a more crucial role in accelerating the resolution of bad debt. We estimate that currently the China banks have resolved around 26 trillion of non-performing assets from a period of 2015 to 2024, and estimated about half of them acquired by the AMCs. And we anticipate that the national AMCs will remain the largest purchasers of distressed assets in China, and helping to resolve a meaningful portion of these new problematic assets in the medium term. We believe the AMCs will continue to fulfill the important policy role of maintaining financial system stability, particularly during periods of economic downturn. When you see in recent years, the AMC's financial profiles have been negatively impacted by the high levels of impairment ratios and credit costs, largely due to the impact of economic slowdown, fair value losses from the assets, as well as asset quality deterioration on the exposures in restructured distressed assets and legacy problematic investments. And in the near term, most AMCs are expected to continue relying on earnings diversifications through their financial subsidiaries, ongoing shareholder support, and lower funding costs to buffer against the impairment losses amid the persistent challenges in the distressed asset management business. However, when you look at the medium term, this larger pool of distressed assets should allow AMCs to become more selective, allowing them to cherry pick assets with better risk adjusted returns. And the risk profiles are also expected to gradually evolve, as the reform should enhance the ability to shift away from the higher risk restructured assets. We expect the national AMC's earnings will gradually recover, even though the trend will largely depend on the recovery of the property market, where we won't see a meaningful recovery until property market stabilizes. That said, we believe earnings to gradually recover over the medium term will reduce asset quality risk, and they're potentially helping to strengthen the capital positions and eventually return to financial health over time.
Thanks, Franco. That's a very nice summary. I'd like to follow up on the inclusion of special mention loans in a pool of distressed assets. What opportunities and challenges do you think AMCs will face in accelerating bad debt resolution under the new regulatory framework?
Right. The inclusion of special mention loans significantly enhances the pool of distressed asset available for acquisitions by the AMCs. When you look at the special mention loans, they amounted to almost 5 trillion at the end of first quarter of 2025, which is almost 1.5 times larger than the existing NPLs in the China banking system. Just to recap, special mention loans are loans that show signs of potential weakness, even though the borrower is still making payments, while NPLs are loans that fail to make payments for a certain period, usually around or over 90 days overdue. And the rising level of special mention loans in China could be a reflection of economic challenges faced in recent years, and the ability for the AMCs to acquire or restructure these special mention loans before they become NPLs can also help to provide better system liquidity as well as diffusing financial system risk. And the larger pool of distressed asset will allow AMCs to select assets that offer better risk adjusted returns and also encourage them to focus more on risk control. We believe the national AMCs do have advantages over the local AMCs or the bank's asset investment companies in the expansion of business opportunities due to the strong existing relationship with banks, the established franchises and market positions, track record in managing distressed assets, better funding access, as well as much larger balance sheets. That said, when you look at the asset growth, it's likely to stay modest for most of them because impacted by the limited capital buffers, slow economic growth, and the more controlled risk appetite since the huge losses faced by some AMCs few years ago. And ongoing competition from local AMCs and the bank's AICs could put more pressures on the margins as they all bid for high quality and safer assets amid the current economic challenges in China. The national AMCs currently the existing low levels of earnings and capital buffers, and also the elevated levels of impairment loan losses, will be the key challenges for most of the financial profiles in the near term, and which will weigh on our assessment on the ability to execute the policy functions. And amongst the four national AMCs, China's Cinda is likely to take more new opportunities in distressed assets due to its stronger capital buffers and followed by China Orient. And meanwhile, CITIC FAM's Tier 1 capital ratio is expected to continue to improve, which should enable it to take more distressed assets over time as well. However, regulatory forbearance also remains in place in near term as it continues to restore its CET1 ratio and its financial profiles.
Okay. Next question is, you mentioned AMCs are going to shift toward market-based acquisition and disposal models. So for investors, what should investors watch regarding the AMC's returns, credit risk, and evolving business models in the coming years?
The national AMCs continue to have a unique role in maintaining financial system stability by purchasing problematic assets in China. And amongst the systemic important financial institutions in China, their business models are considered more volatile given that the stressed assets are inherently carry higher risk and customers are of weaker credit profiles. That said, the AMC risk profiles are also expected to evolve from these enhanced business opportunities as the reforms can enhance their ability to shift away from the higher risk traditional restructured assets. And when you look at the recent years, the national AMCs have accelerated transactions under the acquisition and disposal model, which basically relies on disposal of collaterals for recovery and focusing on their policy role to assist distressed assets in rebuilding their financial profiles and improve their operation efficiency over the medium term. And the acquired assets under the acquisition and disposal model, they're generally classified as financial instruments and fair value. And therefore, when you look at the changes in market prices, it will be directly reflected on the balance sheets and P&L, profit and loss accounts. And when you look at the continued property price pressure in China, we believe that it will continue to weigh on the earnings of national AMCs in the near term, given that many of the assets are currently largely collateralized by the real estates. However, we believe the negative impact to be more moderate for the national AMCs as their property exposures are primarily concentrated in higher tier cities where prices are likely to be more resilient. We expect ongoing shift to the acquisition and disposal model and the use of debt and equity instruments may increase the AMC's exposures to market risk, but this will eventually reduce vulnerability to asset quality risk and on path for better quality of earnings and facilitate and strengthening of capital positions over time when the economy starts to recover.
Okay. Now I'd like to switch over to you, Katie. We know some Chinese AMCs have limited capital buffers and face continued asset quality pressure. Can you talk about the actions they have taken to strengthen their capital positions and risk profiles to cope with the situation?
Thanks, Ying. Yeah, over the past years, AMCs have been taking multiple measures to gradually strengthen their capital positions and risk profiles while addressing the headwinds from weak property market and slower economic growth. The measures will include capital injections, enhanced risk management to reduce the risk from potential capital erosion due to asset quality problem, and also the earnings supplement measures. Some AMCs have received capital injections to address the capital shortfall caused by the asset quality problems. Most recently, China Great Wall received a capital injection of 36.8 billion RMB from Central Huijin. Beyond fresh capital, many AMCs have tightened their risk management frameworks and prioritized risk control over growth to protect their financial profiles. In the meantime, they continue to have strong funding access to the domestic banking system with adequate funding cost. Some continue to issue bonds domestically and internationally thanks to the strong perceived government support. The continued funding access has helped them to mitigate the refinancing and liquidity risk while supporting their ability to carry out the policy functions to acquire distressed assets in the system. Some AMCs also have supplementary income from investments in associates and financial service subsidiaries to support the earning stability, while the profitability from their core distressed asset management business remains subdued with elevated credit costs due to asset quality pressure. This also helps the AMCs to replenish their capital gradually and support their ability to execute their policy functions.
Thank you, Katie. I remember you and I discussed the impact of AMC's ownership change in our previous episode on the topic last year on China Perspectives. I noticed early this year that China's Ministry of Finance transferred its shares in three AMCs to Central Huijin. Could you please share your view on the ownership change and the impact on these AMC's ratings and standalone credit profiles, please?
Yes, sure. A Ministry of Finance transferred its shareholdings in China Xingda, China Orient, and China Great Wall to Central Huijin in the first half of this year. We believe this action has reduced the uncertainty around these three AMC's ownership structures and their future business prospects. From the support driven issue rating perspective, we have been holding a consistent view that the ownership change does not change our government support rating framework and government support rating for these AMCs. We continue to take a look through approach because we believe Chinese sovereign will remain the ultimate support provider for the AMCs, given their crucial policy roles in maintaining financial stability through the resolution of distressed assets in the system, particularly in the downturns. The shift in the shareholder to Central Huijin may streamline the capital support process, potentially improving the timeliness of any necessary support in the future and enabling a more efficient coordination for capital injections if needed. Nonetheless, we believe Chinese government will prioritize the support to other policy institutions and other larger banks with deposit funded balance sheets, leading to a relatively lower government support stance for AMCs. In terms of their standalone credit profiles, we believe reduced uncertainty after the ownership change has already improved AMC's funding access and reduced their borrowing cost. We also believe Central Huijin's involvement in the AMCs as the major shareholder would help to improve AMC's management strategy and risk profile, given Central Huijin's established track record in managing large, systematic, important financial institutions. This should be positively impact AMC's standalone credit profile in the medium term.
Okay, before we wrap up, I'd like to hear your view on the recent upgrade of China Great Wall Asset Management's rating by a notch to triple B flat with a stable outlook. The rating was previously downgraded by multiple notches from A flat to triple B minus between April 2023 and June 2024. So what's the rationale for the recent upgrade? And do you expect any further rating actions in the China AMC space in the next 6 to 12 months?
Indeed, we took multiple negative rating actions on China Great Wall in previous years, mainly due to the company's meaningful capital shortfall from asset quality issue, which we believe weakened its ability to perform the policy role and affected the government support propensity. Also, the inconsistent track records in terms of sufficiency and timeliness of support to some AMCs also affected our view on the government support stance for the sector. But since late last year, we've seen some positive regulatory development for AMCs, as mentioned earlier. Our recent upgrade of China Great Wall's rating to triple B flat with a stable outlook in June mainly reflects the improvement in its standalone credit profile and policy execution capability after the major capital injection from Central Huijin. The upgrade also reflects the growing policy role of China Great Wall as the government increasingly relies on national AMCs to manage distressed assets and mitigate the systematic risk. We also believe this capital injection meaningfully improved China Great Wall's capital position and enhanced its capacity to acquire distressed assets in the system while resolving its own legacy problem assets to restore financial strength. This helps to strengthen its policy execution capability and also the government support propensity in our view. As for the sector, we revised our mid-year sector outlook for AMCs to neutral from negative, as we believe the continued government support should reduce the downside risk for AMC's standalone credit profiles despite the macroeconomic challenges. In the meantime, the rating outlooks for all AMCs remain stable, reflecting our view that the government's propensity and ability to support AMCs are likely to remain unchanged for the next 12 to 18 months. In terms of future rating actions, the rating sensitivities for AMCs, support driven ratings, are mainly depending upon their policy role, specifically their ability to execute their policy functions as indicated by their standalone credit strength. Also, Chinese government support stance for AMCs, including the sufficiency and timeliness of support, will also affect our view for the government support rating. We will continue to monitor any development and also assess the impact on the AMC's credit profile as we go.
Thank you. And that brings us to the end of our podcast. Thank you, Katie and Franco. It was great to get your latest insight on the China AMC sector. I look forward to our next episode on the topic in the future. You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Please subscribe to iTunes, Spotify, or wherever you get your podcast. Take care until next time.